All right, we're now live on Facebook, and let me go ahead and all right. All right, so I'll go ahead and start recording now, and then all right, and then we're live streaming on Facebook. So I just want to thank you all for joining us this evening. We're going to have some folks also join us via Facebook. So I'll be fielding questions from Facebook and also here on Zoom. And I know folks will be coming in while the presentation will be in progress. But I just want to thank you all so much for joining us this evening. And top 10 tax tips for business owners. This presentation is, it's very critical, especially at this time, as we as business owners, entrepreneurs, we begin to not really begin to prepare. We're already, getting our taxes filed, but we have a few weeks left, and for those who will be probably filing extensions. But as business owners, we always have those critical questions on what we need to do and what we need to apply, and how do we, especially avoiding like an IRS audit. We always have those critical questions to ask. So it's great that we have experts like Bill, who agreed to join us to facilitate this presentation to our group, and we welcome him this evening. And my name is Austin Thompson of Thompson Management Consulting. We are a consulting firm that works primarily with startups and those within 0 to 5 years of startup. We typically do a lot of business plan writing, business plan research for small business owners and entrepreneurs, and marketing, feasibility studies, and basically just connect business owners with all the resources they need in order to launch successfully and to get through that startup phase, that growth phase, and into the expansion phase successfully as a business. We work with CPA accountants, we work with web designers, we have connections to the SBA, Small Business Development Centers. So we really have great resources available to us in order to really help our small business clients launch successfully and grow their businesses successfully. I've been doing this now, actually started out as an in-person event for the past 10 years. And officially this is the 9th year. The very first year was just a few workshops that I did, and then I grew that into what is now known as the Entrepreneurship and Small Business Summit. Next year, we celebrate 10 years. We have been live and in person up until 2020, of course, when the pandemic hit. And then everything went online, we went virtual. So we've been on Zoom ever since 2020 with a full online conference, full virtual conference. In 2020 and 2021, full virtual conference. And then 22 and this year, we're doing a series of workshops and a series of webinars with various experts like Bill is going to do tonight. Next year, we will entertain going back live and in person, but it will be a hybrid model. So for those who are interested and are living out of state, can join virtually, and for those even in state, if they're unable to attend in person, can join again virtually. So that's where we are now with the Entrepreneurship and Small Business Summit. We've just been so happy to play a role in assisting small businesses get access to the information and resources you all need to grow successfully and be successful, make critical decisions to grow and scale successfully. So thank you all so much for being a part of this journey and being a part of the Entrepreneurship and Small Business Summit. So I'm going to pass the torch to our presenter tonight. Before I do that, I just want to read his bio, and I just like to let you all know that you are in great company with Bill Hampton. I've known Bill now, oh boy, going back maybe 7-8 years, probably a little longer than that, and he's a valuable asset to this small business community. And we're so glad and so privileged to have him here tonight. So Bill Hampton is the owner of Hampton Tax and Financial Services, LLC. Bill is a financial planner, tax strategist, certified small business consultant, mentor, real estate investor, and speaker. Bill is a former Wall Street executive with over 20 years of financial industry experience. Bill is a certified financial education instructor and registered financial consultant and an IRS registered tax preparer. Bill is currently studying to become a certified financial planner. Bill has appeared in articles in Yahoo News, Financial Planning Magazine, Black Enterprise Magazine, KeeperTax.com, Thrive.com, Stessa.com, and CreditCards.com. Bill was born and raised in New Jersey and currently resides in Atlanta, Georgia. Bill is passionate about financial literacy and diversity, equity and inclusion, which is also known as DEI by its acronym. Bill volunteers with the National Association of Personal Financial Advisors and was the vice chairman of the SCORE Atlanta chapter. Bill and his colleagues of NAPFA won an award in 2022 for creating the first DEI certification program for financial advisors. Ladies and gentlemen, we are so honored to have our speaker tonight, Mr. Bill Hampton.
Thank you for those kind words and that introduction, Austin. Thank you for allowing me to give this presentation to your clients and all of your people in your circle. And I'm glad everybody signed up. I know it's, in the evening. I know you guys could probably be eating dinner or doing something better than sitting on a webinar. So thank you for everyone for joining us today. And I know it's the middle of tax season, and I know some people already got their taxes done, but for those of you that haven't, it's still opportunities for you to do some things to help you save on your taxes and for 2022, as well as plan for 2023. So this webinar and this presentation is designed to just give you some of the things that you can do as business owners. It's not comprehensive. It's not going to cover every single thing that you business owners can do, but I just want to give you guys a taste of some things to think about so that if you're doing your own taxes, you may want to think about doing some of these things, or if you're working with your own accountant or CPA, bring these things up in your conversations and see if you're eligible for some of these deductions and credits, and work with your whoever you're working with to implement these strategies to reduce your taxes. If you don't have someone you want to work with, you can always reach out to my firm. My firm does tax return preparation. We do a number of different things with business owners. We help business owners for the full life cycle of their business. We help with creating LLCs, getting IRS employee identification numbers, helping you to select the appropriate entity for your business. And then we also, can help strategize with tax return preparation and tax strategies to reduce your taxes. I'll put my website in the chat. So if anybody wants to know how to contact me, you can go into the chat and my website is in there. So why don't we get started with the presentation? If you guys have some questions, you can post them in the chat. Austin is going to be handling that, and he'll let me know if there's any questions that you guys have. Okay, so here we're going to go with top 10 tax tips for business owners. The first tip I have, and I see a lot of my clients that don't utilize accounting software. You have to have something to track your income and expenses. There are so many options out there now. There are free versions, there are inexpensive versions. So one of the most important ways to make sure you get all the deductions that you can is you got to track them. So here are a few options for accounting software that you can use. The first one is Wave. It's free, or they have a free version. You can go to and look up Wave. The website is waveapps.com. Next, we have Divvy. Divvy is another option out there. It's a newer option to track business expenses. And Divvy is a little bit different than a lot of other softwares out there. Divvy also allows you to apply for a business credit card. And that's a good way to track your expenses. You should not be using your personal credit card. You should definitely have a business credit card and a business bank account. But with Divvy, you can get a business credit card that's dedicated just for your business. And it's a really, really good way to track your income and expenses. And that credit card will link to the Divvy software. Next, we have Xero. Xero is another option for small business owners. I think they also have a free version. FreshBooks as well. And then finally, Quicken. Quicken is not free, but it's only $50 for the year, so it's very inexpensive. Quicken is a little brother to QuickBooks, and I like it better, obviously, because QuickBooks is very expensive. QuickBooks online is anywhere from $30 to $50 a month, so you can get a whole year of Quicken for the price of 1 month of QuickBooks. So definitely check out some of these options, or an old-fashioned spreadsheet, but definitely use some type of software. Don't, come to your accountant at the end of the year with an envelope with some receipts in it. It's going to potentially cause some problems. Your receipts may have faded, and if the receipts fade, then you can't use them. And then, of course, accountants may charge you extra to put all your information into one of these softwares if you haven't done it yourself. So it's going to save you some time, it can save you some money, and so definitely use software out there, and these are just some of my recommendations. The next tip is to use a separate business bank account to track your income and expenses. I know some business owners don't do that, and that's not good for several reasons. Number one, you can run afoul of the IRS if you commingle your business and personal expenses into your personal bank account. So I always strongly recommend that if you're serious about doing business, set up an LLC, get an employer identification number, and then go down to your local bank and open up a business bank account. So that way, if you have any income or expenses, those income and expenses go into the business bank account, and they're not commingled with your personal bank account. I've seen clients who don't set up a separate business bank account, and then at the end of the year, they have to go through 12 months worth of bank statements and try to figure out what was business and what was personal. And that can be very painful, can be very, take a long time. And it's just better to start off, since we're towards the beginning of the new year, with a separate business bank account. And also, you got to look at it like this. If you're serious about business, you got to treat it like a business. Otherwise, if you're not treating it like a business, you're treating it like a hobby, or you're treating it like a hustle. And, that's very unprofessional, and it's not a good way to run your business. So definitely get a separate bank account. If you don't know how to set up an LLC and get an EIN, please reach out. We'll be happy to help you. The next is you have to account for taxes if you're going to be in the gig economy. That means if you're doing Uber, you're doing Lyft, you're doing TaxRabbit, or some other kind of gig economy job, Instacart, you got to understand that you have to pay taxes on that income. You're going to be a 1099 contractor, and you're not going to get a W-2, so they're not going to take taxes out. So you have to account for your own taxes. So I advise my clients that are working in the gig economy, like the Ubers, the Lyfts, Instacart, is set aside approximately 30% of every paycheck or all the money you receive for taxes. That might be a little much, but it's better to err on the side of setting aside too much rather than setting aside too little. And then also, um, at the end of this year, everyone who made more than $600 on a 1099 was supposed to get, a 1099K. But the IRS pushed back the rule until the end of this year. So if you're working in the gig economy this year and you make more than $600, you're going to get a 1099K. So previously, people that were making money like this, they may not have been reporting it to the IRS. And the IRS decided to crack down and say, okay, people that are getting paid for selling stuff on Shopify or selling stuff on Etsy, and people are making money, and on these 1099s, a lot of people weren't reporting them all of their income. So the IRS says the previous rule was you had to make at least 10 grand when you had to have at least 200 transactions to get a 1099K from places like PayPal or Cash App, etc. Well, the IRS made the change, so now it's going to probably scoop up everybody. So if you made more than $600, expect to get a 1099, and if you're not sure what to do with that, you're gonna have to probably reach out and get some help from a tax professional. I don't recommend trying to do your own taxes on TurboTax. I've seen people do it, and they usually fall into one or two categories. Category number one is they don't take all the deductions that they're entitled to because they don't know them. They're not, tax accountants. Or they fall into another category where they take deductions that they aren't entitled to, and then they get audited by the IRS because they took something that they weren't supposed to. So there's a lot of rule changes with the IRS in the last couple of years. And don't try to do your own taxes. It can only be a recipe for disaster. I've just seen it happen, so much that people think, oh, I'm going to save a couple $100, but they end up, missing out on potentially thousands of dollars in tax deductions that they don't know about. So you really didn't save any money. Okay. Next, we have business meals expenses. Yes, you can deduct business meals, but you have to follow some rules. So the IRS said that during 2021 and 2022, you could deduct 100% of your business meals that you got at a restaurant. The reason they did that was because a lot of restaurants were going out of business due to the pandemic. So they wanted to throw a lifeline to the restaurant industry. And they said, okay, normally business meals are 50% deductible if you get it from a restaurant, whether it's an eat-in restaurant or you get it to go. And for 2 years, they changed it to 100% tax deductible. Well, now that's over. So now we're going back to 50% deductible on business meals. Now, there are certain things or certain rules that you have to follow to qualify for the business meal deduction. And I'm going to just tick off some of those right now. So the first one is that you have to have at least 2 people at this business meal. You can't go out to dinner by yourself and call it a business meal. You have to have someone there that you talk about business with. Now, I know I've had some people say, well, what if I'm schizophrenic and I talk to my other personality? Well, the IRS says that's fine, but you can't take that as a tax deduction. So it has to be at least a second person there. So that's rule number 1. Rule number 2, you have to talk about business. It doesn't have to be for, the whole meal. You can talk about business for maybe the first 15 minutes, half an hour, whatever that is. And that's sufficient. Rule number 3 is you have to document what you talked about. So I recommend to my clients to write on the back of the receipt who was at the meeting and what you talked about. It's pretty simple. And, it doesn't have to be a long drawn out, example or, what you talked about. It could be something like, hey, we talked about, marketing or, creating a new website. As Austin mentioned, he knows people that do websites. Or you could say, you had a meeting with your business partner and, you want to go over your income or your expenses, income projections or expense projections. Or you want to talk about, this, webinar, you learn some good tax tips and you want to discuss it. So anything is as long as it's legitimate business, you can, write it down and discuss it, and you can have and get that deduction. The next rule that you want to follow is the meal has to be reasonable in cost. It can't be extravagant. So what does that mean? It means you can't go out to dinner and say, hey, Bill Hampton says this meal is 100% tax deductible, so let's, buy a $5,000 bottle of wine, to celebrate. Well, most people don't spend $5,000 on a meal. I mean, unless you're some kind of multi-millionaire, yeah, you can do that. But most normal people spend $100, $200 at a meal, and that would be reasonable and in cost, for two people. And then finally, the frequency of the meals has to be reasonable. So what does that mean? It means you can't go out to dinner every single week and call it a business meal. You can't go out to dinner with your spouse or your business partner and say, hey, we're going to talk about business, 50 times a year. That would be a little excessive. I would recommend to my clients, go out to dinner once a month, with your business partner, with your spouse, and, talk about business. And if you do that 12 times a year, that's reasonable. And if you follow the other rules, you'll be fine. Okay. But there are certain things that, qualify besides a meal with the spouse or business partner. It could be a meal with the customer or, potential client or an existing client. Meals can be in the office. That means if you, order something from a restaurant and they deliver it, that's fine. It can be, a meal, or a dinner, at a party or at a restaurant. Or if you have employees and you provide, meals on the premises for your employees, because they're working late or they're working hard. Yes, you can, order a meal from a restaurant, have it delivered, and that will be a business deduction. Let's see. So, and of course, like I said, there have been some changes with tax laws. Like I said, 2021 and 2022, the meals are 100% deductible, but starting in 2023, it's only 50% deductible. But that's still a good benefit. Reduces your taxable income and reduces how much you pay in self-employment tax. Those are the benefits. The drawbacks to this strategy is you have to have some record keeping. That's where it goes back to what I said earlier about using accounting software. A lot of these accounting softwares, they will let you scan your receipts from the business meal and then upload it right into the software. So that's one of the benefits of using, the softwares that I mentioned. If you have that receipt, you don't want to have to, you can manually enter it, or you could, scan it and upload it right into the software, which is a lot easier than manually entering something into a spreadsheet. So this is exactly why you want to have some accounting software. And the new accounting software is, really great for capturing pictures of receipts and allowing you to make sure you don't miss out on any tax deductions. Okay. The next one is hiring children. So everybody wants to know, how can I hire my children and get a tax deduction? Actually, you can hire children and you can hire a spouse in your business, and you can get a tax deduction for that. So, but there are certain things that you have to do. If your children are under 18, they're not subject to Social Security and Medicare taxes. So that's great if you have a 15, 16, 17-year-old. If your children are under 21, they're not subject to the unemployment tax, federal unemployment tax. They will be subject to Social Security and Medicare taxes, but they won't be subject to federal unemployment taxes. Now, any payments that you pay to your children, whether you're paying them on a W-2 or whether you're paying them on a 1099, they're going to have to pay some income taxes unless they fall into the exclusionary where they don't have to file a tax return. So normally that's around about $12,400, $12,500. If they make less than that, which is what the standard deduction is for 2023, then they will not have to file a tax return. So that's another benefit of hiring your children. You can pay them and they won't have to file a tax return if it's under the standard deduction. Now, you can't hire, every child. Children under 8 are considered too young to work, you know, 7 years and younger, considered too young to work. But you can still get around that. One of the ways of getting around that is by using your children as models. So for instance, if you have a website, and every business should have a website, you can put pictures of your family on the website. And if you do that, you can pay your child and your spouse as for modeling. Now, it has to be reasonable, but you can, in theory, pay them for using their likeness, and that income, depending upon their age, may or may not be subject to Social Security or Medicare or unemployment taxes. And that's a great way to introduce your kids to working in the work world, make them, give them some responsibility. And it's also good for you because you get a tax deduction. Instead of paying some stranger, you can pay your wife or you can pay your child to do certain things in your business that can help you out and benefit them as well. So again, you can use your child to advertise your business. You can use your child to clean your office, depending upon their age. You can also have them make deliveries, or, depending upon what type of business you have, they can do other work. For instance, if you own rental properties, you can pay them to cut the grass at your rental properties, and they would get income and you would get the grass cut. Some of the benefits is it will reduce the taxable income to your business. And if your child makes money, they can put that money into a retirement account. It will reduce the self-employment taxes that you pay. And any amounts paid to the child that is below or matches the standard deduction was not considered, taxable income. Some of the drawbacks are if you're paying your employees by W-2, you have to put your child on a W-2 and pay them on payroll also. If you're not paying them on a W-2, you have to issue them a 1099. And you're going to have to establish bank accounts for your children. And you want to make sure that you don't violate any labor laws, so make sure that the work that they're doing is appropriate for their age. And you're also going to have to create a job description for your child or for your spouse. So that way they have legitimate duties. In case the IRS ever audits you, you can say, hey, I created a job description. Here it is. This is what they do. Now, the IRS, probably won't audit you, but if they do, it's definitely good to have a job description created, before they start work, and then also have a set salary for them, whether that's W-2 salary or 1099 salary. But that's how you do it. If you have some questions or you need some help with that, please reach out. We'll be happy to help you set this up properly so you make sure everything is done by the book. Now that you've hired your children, there's another benefit to hiring them. Once you've hired them, you can create an IRA account for them. Now that your children have earned income, they can create an IRA. And they can create a traditional IRA, or they can put the money into a Roth IRA. There are obviously, benefits to both options, but with a traditional IRA, the limit is $6,000, and they can contribute the full amount of their earnings into that IRA. Okay, whether that's a Roth or traditional. And there are some benefits to this. It will reduce your child's taxable income by contributing to that IRA. It reduces the payroll taxes that they would pay. And also, starting young will allow the account to grow significantly, for a number of years. If they're in their teens, that money could grow for 50 years if they don't touch it. 50 years or more. And see, some of the drawbacks are they can only contribute up to the amount that they've earned, and they cannot exceed IRS limits. But just give me an example of, let's say you just you pay your children and they put the money into a Roth IRA, and that's after tax contributions. They can let that money grow, And then when they're ready to go to college, guess what? Now you have a college fund for them. They can withdraw that money out of their IRA. As long as the money's been in the Roth IRA for 5 years or more, they can withdraw it and not have to pay any penalties. Another option for this is they can contribute that money, and if they don't decide to go to college, they can use it for a wedding. Okay, if they've had their money in there for longer than 5 years, or if you want, they can use it to buy themselves a vehicle. So there's a lot of flexibility with the Roth IRA as long as the contributions have been in there for 5 years or more. And I like this better than contributing to a 529 plan for education purposes because of the flexibility. What if your kid doesn't go to college? You got money sitting in a 529 plan. You can have to wait till you have another child, or you have to wait till you have grandkids, and then you can use it there. But with a Roth IRA, they don't go to college, no problem. They can let it sit until they retire. Though again, like I said, they can use it for a wedding, use it for a car, or any other purpose. So there were some advantages to paying your children and putting that money into a Roth IRA. Next, we're going to talk about bonus depreciation. So I know some of you guys have heard about bonus depreciation. You want to know what it is. Well, basically, depreciation means that when you buy an asset for your business, it's going to decrease in value over time, whether that's a computer, whether that's a printer. I mean, computers become obsolete every 4 to 5 years. So you have to, update those things. And depending upon, type of business you could have other things that can be depreciated. For instance, if you own rental properties, you can bonus depreciate items in your property, like appliances, or if you have a short-term rental, furniture, things like that. Well, again, one of the things that has changed, over in recent years was the Tax Cut and Jobs Act included a provision for bonus depreciation for business owners. And business owners were allowed to take up to 100% bonus depreciation up until 2022. Starting in 2023, that goes down to 80%, and then it's going to drop, every year. But with bonus depreciation, you can buy items that are used in your business and accelerate the depreciation. So for instance, let's say you bought a computer or a printer for your business. Normally, IRS regulations would say you would have to depreciate that computer or printer over 5 years. But with bonus depreciation, if you bought that computer in 2022, you could take 100% and depreciate it all in the first year. So if you bought a computer, you paid $1,000, instead of depreciating it over 5 years at $200 a year, you can do bonus depreciation and take that full $1,000 at the end of 2022 on your tax return. For 2023, like I said, it's going to change. So if you buy a computer in 2023, you're only able to do 80% bonus depreciation. So that same $1,000 computer, you would take $800 in the first year, and then the remaining $200 you'd have to spread out over 5 years. But that's still a pretty good deal. I mean, you're getting 80% of the cost, in the first year that you buy the item. So that's what bonus depreciation is. And those are just some examples of how you can use it. You can also use bonus depreciation with certain vehicles. Now, this is sometimes called the Hummer rule. If you buy a vehicle that weighs more than 6,000 pounds, and those are usually SUVs like Hummers and other heavy vehicles, you can bonus depreciate that vehicle. Now, there are some rules here you have to follow, though. The vehicle has to be used 50% of the time for business, or over 50% of the time for business. So that means that it's usually, this benefits mostly people who drive a lot for work. So if you're a real estate agent and you have a fancy car like a Hummer or some other kind of SUV, and you use it to drive to showings, to show properties to clients, and you're driving a lot, then that might be, you could take advantage of this bonus depreciation on a vehicle. Now you have to track how much you use the vehicle, but this is a good strategy for people that have vehicles they drive a lot. It could also be used for other vehicles. For instance, if you have a garbage disposal business, when you buy a new dump truck, or you have some other business that use heavy equipment. This is up until 2022 is a great time to buy those vehicles and take the 100% bonus depreciation. Tow trucks, anything that was a heavy vehicle will qualify for this. Now, you could also take the SUV deduction on what we call a Section 179, and that's a different section of the IRS law. But you have options on different items that you can bonus depreciate. And some of the benefits of bonus depreciation are it reduces your taxable income. It's going to reduce self-employment taxes. Now, there are some drawbacks to this strategy. If you take the maximum amount of depreciation in the current year, then you're not going to get depreciation in future years. So what does that mean? It means if you take 100% bonus depreciation on your 22 tax return, then you're not going to have any depreciation left in future years. You're going to get everything in 1 year, and you're not going to have any way to take that deduction in future years. And then next potential drawback is what we have. It's called depreciation recapture. That means if you buy this Hummer or you buy some other vehicle and then you decide to sell it, then you have to pay what's called depreciation recapture. And so in that kind of instance, the simple way to avoid that is don't sell it. Just, when the car dies, just junk it. Don't try to get any money for it. Or if you bought a computer, don't sell it. Just trash it and get a new one. So that way you can avoid the recapture by not selling the item and just, writing it off as it's obsolete. Okay, next I want to talk about some retirement plan options for clients. I see a lot of people that start businesses, but they never put any money aside for retirement. They're just running the business and they're putting the money back into the business. That's not a good strategy. If you're working in your business, you should be setting aside some money for retirement. I mean, unless you plan on working till the day you die, you're going to want to retire at some point. And if you're self-employed, the way to do that is to put some money aside. Now, it's going to benefit you two ways. Obviously, if you're putting money into a retirement plan and you can avoid paying tax on that income, and you're also putting money aside for your future self so that you can retire at some point. One of the options for business owners is what we call a self-employed pension or a SEP plan. And it's called a SEP IRA by most people. And it allows employers to make contributions up to 25% of each employee's pay. So that means as a business owner, you're an employee, so you can put money away, and you can put money away also for your employees. The maximums on SEP IRAs are very, very high and allows you to contribute, a lot. So let's say you make $100,000 in your business. You can put up to $25,000 into a SEP IRA. That's a lot more than a traditional IRA, which is $6,000 if you're 49 and under. If you're 50 and over, $7,000 for traditional IRA. But a SEP IRA, 25% is a good amount of money that allows you to set aside. And it's great for family businesses. So that means if you have a spouse or children and you're employing them in your business, you can open up a SEP IRA and put money aside for everybody that's an employee in the business. And that, again, reduces your tax liabilities and the taxes you pay to the government, but it also helps set up your family for retirement, you, your spouse, and your children. So SEP IRAs are a great, great idea. But you gotta, again, put some money aside. You gotta put it into your budget. Whatever money comes in, set aside 25%. Don't, put all of that money into your bank account and spend it, unless you, again, plan on working till you die. And I know most of us don't want to do that. So definitely, help your future self, put some money aside for retirement. So, you have a question? Go ahead. I can't hear you. I'm sorry. Can you type it into the chat? We can't hear you.
Yeah, if you type, you're breaking up there. So if you type it into the chat, I can read it.
Okay. All right. So the benefits, any size business can open up a SEP IRA, whether you have one employee or whether it's just you or you have 100 employees or 1,000, you can open up a SEP IRA. There are no filing requirements for the company. There are very low administrative costs depending upon who you utilize for your SEP IRA. Employees are 100% vested. That means that, they don't have to wait for a vesting period, 3 years, 5 years, whatever, to be able to, to access their IRA retirement accounts. Flexible annual contributions. You can, depending upon how much money the business makes, you can, in good years, you can put more money in bad years, you can put less money in. And it's a great option for your cash flow. And you can still make a contribution into a SEP IRA for last year up until you file your tax return. So even including extensions. So let's say you haven't filed your taxes yet, you file an extension, and you have until October of 2023 to make a contribution to a SEP IRA for 2022. So that would give you 10 months to put money in for the previous year. That's a great tool. And, like I said, you may not know how much profit your business had until you actually, do your taxes. And then once you do your taxes, let's say you hire somebody to do your taxes and they say, yeah, you're going to owe the IRS $5,000, $10,000. You don't want to owe the IRS, put $5,000 or $10,000 into that SEP IRA, and that could greatly reduce how much you owe to the IRS. So you would have a choice. You could either give that money to the IRS or give it to your future self. And my recommendation, of course, you would know, is give it to your future self. Put that money to the IRA, let it grow, and don't pay that money to the government. Keep that money in your hands. Yeah, you can't spend it now. Yes, I know you would have to wait until 59 and a half to touch it. But if you're a business owner, a lot of us already, we're in our 20s, we're in our 40s or 50s or whatever. You don't have that long to go before you can tap into that money. So definitely consider this, even if you haven't filed your taxes yet. This is a great option. Now, some of the drawbacks to this strategy is that only the employer can contribute to the SEP IRA. An employee can't make any contributions on their own. And as an employer, you have to contribute equally to everybody in the company. That means you can't give yourself more than you give your employees. Everybody has to get the same amount. Okay. But again, that's why it's very good for family businesses. And then lastly, there are no loans involved. With a 401k, in certain instances, you can get a loan from a 401k. But from a SEP IRA, there are no loans involved. So, but still, SEP IRA is still a great option for people. My son is 16, turns 17 next year. Does he have to wait till 18 to get a Roth? No, he does not have to wait till 18. As long as he has some kind of earned income, he can put that money into Roth at whatever age he is. So there's no requirement that you have to be a certain age. The only requirement is you have to have earned income. That could be from a paper route. That could be from doing Uber deliveries. It could be from anything. As long as he has earned income and he received a W-2 or he received a 1099 showing income, your son can open up a Roth IRA. And that's a good question. Thank you, Rosemary. Okay. Our next strategy is 401k business contributions. So I know some of you guys work for big companies, and I know the big companies have 401ks, like your FedExes and Coca-Colas and Deltas. They have 401ks, but you don't have to be a big company to have a 401k. You can be a one-person company and you can open up what's called a solo 401k. Okay, just like the big guys. Now, you would have to, work with, financial institution, just like with your, your SEP IRA. You're gonna have to go through, a bank or brokerage account, to do this. And if you need some help, please reach out. We can, show you how to do this and set this up and take advantage of this. So with your 401k at your job, you contribute money to your 401k, but your company also has a match. At least some companies do. They'll match it at 2, 3, 4, 5% of whatever you contribute. Well, you can do the same thing if you have your own business. It's called a self-directed or solo 401k. Again, you can, set it up through different financial companies. If you don't know, please reach out. Contribution can be made from the business owner's profits, and you can contribute to these plans. The contribution limits on the business owners is set by the IRS, and it's up to 100% of their income, self-employed or less. The business can make an additional contribution of up to 25% of the business owner's annual income or to the annual contribution limit. So contributions change every year. So you definitely want to make sure that you follow the IRS guidelines, whether you're making a 2022 contribution or a 2023 contribution. And as a business owner, you can put a good amount of money away through this option. Now, the good thing about this with solo 401ks, there are two different types of contributions. There are employer contributions that you make as the business owner, and there are employees contributions that you make as the employee of the business. So when you have a 401k, you are both. You are the owner and you are the employee. So you can make contributions to both, and that's a great strategy to put a significant amount of money away. With a solo 401k, you can actually put more money away than you can with a SEP IRA. With the SEP IRAs, you're limited to 25% of your income, and that's correct as a business owner. But as an employee, you can also put additional monies away as an employee. Okay, let's see. It looks like we got a question. Would Roth cause him not to get approved for financial aid if he applies to college? Well, Rosemary, that's a question that I can't get into right now, because that's not related to what we're talking about today with business tips for business owners. So I would think that that's something that you can contact me offline, and we can set up a consultation, and then we can talk about strategies for saving for college. But that's not going to be something that I can talk about today. We're going to stick to tax tips for business owners. Okay, we're not going to get into saving for college. But that's a good question. So let's see here. So as I was saying, with solo 401ks, you have the business owner can make the contribution and the employee can make the contribution. All right, so let's talk about some of the benefits and drawbacks to the business owner's contributions to a 401k. You can have, the benefits are you can have other retirement plans. You can have a 401k and a SEP IRA. The business can be of any size. Like I said, it could be one employee, or it could be 1,000 employees for 401ks. Well, that's not true. Solo 401ks are designed for business owners and their spouses. So if it's more than you and your spouse, then you're not going to get the benefit of the solo 401k. With solo 401ks, contributions are not required. If you have a bad year and you don't make enough money, you don't have to contribute to the 401k as a business owner. And so if you have, issues where your cash flow is good some years and down some years, this is a great option for you. If depending upon who you have your 401k with, you may be allowed to take loans and what we call hardship withdrawals, depending upon who your sponsor is. Earnings from the 401k can be tax deferred. That means you can have a traditional 401k or tax-free, which could be Roth 401ks. Again, that depends upon the company that you utilize as your sponsor for your 401ks. Oh, excuse me, your custodian. And then finally, you can make contribution to the solo 401k and receive a deduction in the current year to reduce the taxes for the business. So that means if your business makes, let's say, $100,000, and then as a business owner, you contribute $25,000 as a business owner to the 401k, then your taxable income goes from $100,000 to $75,000. So that's a great benefit to have. Again, you're saving for retirement and you're reducing your tax at the same time. Okay, now there are some rules and some drawbacks to doing this. You would have to file a form 5500 every year, but that's something that your custodian can do. You will have to pay some administrative costs depending upon who your custodian is. And there are contribution limits, which change every year with solo 401ks. And this is not an option once you have employees. So what that means is that if you're the only employee or you and your spouse are the only employees, you can have a solo 401k. Once you have any outside employees outside of you and your spouse, you're not eligible for the solo 401k anymore. And then finally, if you withdraw money from a 401k before 59 and a half, you will get hit with a 10% penalty on those withdrawals. Okay, now that we talked about contributions that business owners can make, let's talk about employee contributions. Again, like I said earlier, when you have a solo 401k, you are the employer and you are the employee. So you can make contributions as an employer, and you can also make contributions as an employee. Based on IRS guidelines, your contributions, if you combine employer and employee contributions, you can put up to about $61,000 into a 401k. That includes employer and employee contributions. So imagine that you make $100,000, you put in $61,000, and you max out on your 401k contributions. You only pay tax on $40,000. You do that for 10 years, you got over $600,000 set aside for retirement. That's a good chunk of money, that you can set aside and live off of. Even if you don't do it for 10 years, let's say you do it for just 5 years, $300,000 is a good, retirement nest egg to live off of. So again, think about your future self and, think about setting up and creating a solo 401k if you're self-employed and it's only you and your spouse. Again, if you need help, please reach out and we'll be happy to, help you with something like this. Again, the benefits, you can have other retirement plans besides the 401k. You can have IRAs and 401ks. Again, contributions are not required from the employer or from the employee. If your business doesn't make enough money, that's fine. Just to contribute that year, and contribute the following year. And again, there are administrative costs for having custodian, handle these type of accounts, but those fees will be business deductions. And again, these are not for businesses that have employees outside of a husband and wife. So I'm going to give you an example of what it would look like contributing to a 401k. So this is just going to be for an employee contribution. So the maximum employee contribution is $20,500. If you're 50 and over, you can put in an additional $6,500 for a max of $27,000. Okay, so let's say you have your self-employed business and you have a salary of $75,000. You contribute to your 6% to your 401k, and you're in the 22% tax bracket, and you're filing as a single taxpayer unmarried. So 75,000 times 6%, you're putting $4,500 into the 401k. It's not a lot. At the 22% tax bracket, that saves you almost $1,000. Okay. Would you like to do that? Would you like to put $4,500 away for retirement and then pay the government $1,000 less? I know I would. Now, let's say you decide to put a little bit more, away for retirement. You want to get a little more aggressive. At $75,000, let's say you put away 10% of your salary. That's $7,500. If you're in the 22% tax bracket, $1,600 in tax savings. That's $1,600 you don't pay to the government that you get to keep. And you put $7,500 away for retirement. And that gets you closer to, not having to work and, being able to retire. So again, this is retirement plans are great benefits if you're self-employed. You just have to be able to take advantage of them. And don't be afraid. They're not that hard to set up, and there's a very good benefit to setting them up. Next, we're going to talk about cost segregation studies. Now, these are for people that own business owners who own property. So let's say you're a business owner and you own your own building. If you are, doing well enough where you own the building that your business is located in, or let's say you're a real estate investor and you own rental properties, whether that's a long-term rental, whether that's a short-term Airbnb rental. Cost segregation studies are a great way to reduce the taxes on your business. This is really very good for restaurant owners. If you own your own restaurant, a cost segregation study can save you literally, tens of thousands of dollars, potentially maybe, in the hundreds of thousands of dollars. So cost segregation basically means you're taking accelerated depreciation on the property that you own, whether it's a commercial building, whether it's a, rental property. Again, depreciation means that when you own a structure, that structure is going to lose its value over time, at least the building structure. The land that the property is on is not going to lose its value. So the IRS regulations state that, land's never going to, decrease in value, but a building structure will over time. So if you have, again, a house or a commercial building, a restaurant, some other structure, you can do cost segregation studies and utilize that to depreciate the property more quickly. So with residential properties, they're depreciated over 27 and a half years. For commercial properties like apartment buildings or, office building or a restaurant, that commercial property is depreciated over 39 years. So that means, let's say you had a commercial property that was worth $1 million. You would be able to take $25,000 approximately in depreciation. That's, 1 million divided by 39 years. And it would take you 39 years to get that $1 million back in depreciation. Well, what a cost segregation study does is you would hire professional engineers to go out and put the value on the components inside the building. So every building has, components. For instance, every building is going to have a plumbing system. Every building is going to have HVAC system, and every building is going to have an electrical system. You got to have lights, you got to have water, you got to have, heat or air. So with a cost segregation study, and this is something that my firm also offers, we go out and we take a look at your building and we put values on the different components in that building, like the HVAC, the electrical, and the plumbing. And then what we do is we depreciate those items over a shorter lifespan versus waiting 39 years to get everything back. We can say, hey, and we can look at the carpeting, we can look at the light fixtures, kitchen appliances, etc., and say we're going to depreciate these items over 5 years, 7 years, or 15 years, instead of waiting 39 years to depreciate them. And that means you're going to get your money back more quickly on depreciation. So again, in an instance where, let's say you would have $1 million property and the engineer comes out and they say, okay, we're going to say that the HVAC system is worth $100,000. The plumbing system is worth $100,000. And the electrical system is worth $100,000. So out of that $1 million, we have $300,000 in components that we can depreciate more quickly. So what you would do is you would say, instead of taking those $300,000 in components and getting that money back in 39 years. Let's get that money back in 5 years. So that means $300,000 over 5 years, you're getting $60,000 in extra depreciation. So in that previous screen, you were getting $25,000 in depreciation. You could be getting $85,000 in depreciation. That's for the next 5 years. So that accelerated depreciation is really, really helpful, because that's money that can reduce the taxes that the business owner pays. And cost segregation studies are a great option for you. They're not that expensive. Depending upon what type of structure you have, whether it's a residential structure, could be $2,000 to $3,000. On commercial buildings, it's going to be a lot more expensive because commercial buildings are bigger than a single family house. But it's still something that you should look into if you own rental properties, or if you own your business owns commercial structures. It can increase your overall deductions in the early years to reduce taxable income that the business has to pay. And it can allow for a bonus depreciation or a Section 129 deduction for property that normally wouldn't qualify for these type of deductions. Some of the drawbacks to this is that since you're getting the depreciation accelerated, or you're getting it early, then that means you won't have the capability of taking those depreciation deductions in later years. So if you get the depreciation on the HVAC, electrical, and the plumbing in the first 5 years, and you hold the building for 20 years, then the next 15 years, you won't be able to take those deductions on your tax return. But it's always better to get the money quicker rather than later. There's a financial strategy called the time value of money, and that time value of money means that if you're getting money earlier, you can reinvest that money in the business, or you can put that money in your pocket and you can invest it. And by getting the money sooner, you can let it grow potentially faster than waiting 39 years to get it. So the time value of money means just getting the money sooner benefits you as a business owner versus waiting to get it later. And then also you have to factor in inflation. Getting the money now is going to potentially, that $1 you get now could be worth more than $1 you get 39 years from now due to inflation. So that's something to think about if you own rental properties or if you own a commercial building as a business owner. Next, we have the home office deduction. Everybody's heard about the home office deduction. If you work out of your home, you can take this deduction. Now, if you're an employee and you have a W-2 job, you cannot take the home office deduction. You have to own a business. So that's something that a lot of people get confused on. W-2 employees don't qualify for home office deduction. If your company is letting you work from home, you don't get a tax benefit from that, at least from the home office. The benefit you get is you don't have to drive into work every day. You don't have to take the MARTA in every day. So that saves you wear and tear in your car, and it saves you gas. So that's your benefit. But if you actually own a business, then you're eligible for the home office deduction. Now, there are certain things or certain rules you have to follow. It has to be exclusively and regularly used for business in your home. That means it can't be, your dining room table. That doesn't count as a home office. It has to be, a dedicated space for the home office. And that home office could be utilized to meet with clients or patients, or just, it's just your, private space to go and work, to get away from, the kids or somebody, so you can have some privacy and have some quiet space. You can also get a home office deduction for a storage unit. So for instance, let's say you have a business where you sell things on Shopify and you buy things in bulk. You can store that items in your garage, or you can store it in a shed, and that would qualify for the home office deduction. So it doesn't have to actually be an office. It could be storage as well, that you can get the home office deduction. And you can also get a deduction if you have a daycare facility at your house. If you use a portion of your house to watch children and you have it set up as a daycare and you're licensed by the state or the county, then yes, you can use the home office deduction for daycare facility space. And you can also have a structure that's not attached to your home and utilize that for the home office deduction. As I said earlier, if you have a shed, and some people buy sheds and they make that their home office. They go out and work in the backyard to get out the house, or they again use a shed to store, things they sell on Shopify or Etsy. If you use your shed, you can still qualify for the home office, even if it's not in the main portion of your house. The benefits are you can take the home office deduction two ways. We have what we call a simplified method, which means that the IRS says you can take the square feet of the room or the space that you use and multiply it times $5, and that could be your home office deduction. So let me give you an example. Let's say you have a room in your house that you use as your home office. It's 10 by 10. So that's 100 square feet. You multiply that times $5, and you have a $500 deduction for the home office. Now, that's what we call a simple or simplified method. Now, there is a second method, but it involves a little more work, and it's called the actual expense method. So what does that mean? It means that you have to get the square footage of your whole house and the square footage of your home office, and then come up with a percentage. So let's say your house is 2,000 square feet, and you have your 10 by 10 room as your home office. That's 500. Okay, so that's 1/4 of your house is your home office. So what you would have to do in the actual expense method is add up all of your expenses related to your house. That means your homeowner's insurance. That means your utilities. That means gas, electric, water, etc. Take that number and then multiply times 25%. And then you can get, that's what we call the actual expense method. It's a lot more work involved. So most people don't want to do that. Most people don't want to add up 12 months worth of utility bills, electric, water, and gas, and then multiply that times, 25%. So if you don't want to do all of that math, take the simple method, take the square feet of that room that you use for business, multiply times $5, and call it a day. So those are the two ways to qualify for the home office deduction. All right, so we're at the end of our presentation. We can ask some questions. Now, we have more than actually 10 tax tips. I know if you guys are accounting, you're gonna be like, Bill, that was more than 10. I know, that's what I like to do for my clients. I like to do for my buddy Austin. I'm gonna give you more than 10. I'm gonna give you some bonus tips. Tip number one, hire a tax professional. If you own a business or you own rental properties, don't do your own taxes. I've seen so many people try to do their taxes on TurboTax, and then they come to me, and then I have to give them the bad news. I'm going to say, we have to amend your tax return. You either miss out on some deductions, and you thought you were saving a couple $100 because you didn't want to hire a professional, but you left $1,000 on the table because you didn't work with the tax professional. You didn't take the home office deduction, you didn't take any retirement plan deductions, et cetera, et cetera. Or potentially you took some deductions you weren't entitled to. And the IRS could potentially audit you. So we have to go back and amend that return and take some of those things off of your tax return. So I've seen both things happen. I don't want that to happen to you. I would strongly recommend that if you own a business, run it like a business. Get a professional to help you on your taxes. And anything in your business where you are not an expert at, delegate it. If you're not good at creating websites, call up Austin, get his recommendation for creating a website. If you need some paperwork done, get a virtual assistant. You can hire people on Upwork or Fiverr and do all kinds of things for you. Create business cards, create flyers, et cetera, et cetera. Delegate, delegate, delegate if you do not have the expertise. And just for two reasons. Number one, the person's probably going to be better at it than you are. And number two, whatever you pay that contractor, whatever you delegate to them, you can be able to write it off as a business expense. It's going to be a tax deductible business expense in most cases. Okay. So please don't do your own taxes and miss out on $1,000 worth of tax deductions because you're trying to save a couple $100. All right. Looks like we got another question. Very good tips. Well, thank you, Gene. I appreciate that you like the tips and they're very easy to understand. There's a lot more out there. These are just 10. There's dozens of more tax deductions and tax strategies that business owners don't know about, or at least my clients know about them because they work with me. But if you're doing your own taxes, you may not know about them. I always say there's two types of accountants out there that do taxes. There's what we call reactive accountants, and we have proactive accountants. The reactive accountants are going to say, hey, give me your spreadsheet, give me your profit and loss statement, I'll do your taxes. And then they do the tax, they give it to you, and you never hear from them again. Then we have what we call the proactive accountants, like myself. We offer tax planning services at my firm. We offer tax planning services for individuals that need help with their personal finances, like the young lady who asked about, will a Roth, IRA affect her, her kids when he goes to college. And then we offer, tax planning for business owners that, say, hey, Bill, I heard your presentation. I think I might not be taking advantage of all of the tax deductions, possible. I don't have conversations with my accountant. He just does my taxes, doesn't make any recommendations. Well, we can review your taxes. We can, run it through our software. We can tell you what you're missing out on, and we can help you, save potentially thousands of dollars on your tax return now and into the future, with, a number of different strategies. So, please, get a professional, whether it's me or whether it's somebody else. A good accountant is definitely worth more than what you pay them. I mean, a good accountant is going to save you more than what you pay them if you're utilizing the strategies that that they recommend. Again, it's going to save you thousands of dollars a year, and it's going to be worth the time and money to get the help. So that's my presentation. Anybody have any questions? Austin, you have anything you want to add or ask?
Yeah, I just want to say thanks. But man, that's a wealth of information. And I know you're going to bring it. I know you're going to bring the information on the tax tips. This is a great opportunity for anyone out there who want to ask questions. I know you came ready with questions. You may not have put it in the chat, but we've got about 12 minutes, 12 minutes. Want to respect everybody's time. So please, right now, if you have questions, unmute yourself and then ask a question. I've got a couple, but I want the audience to to go ahead and ask questions.
Okay. Oh, and by the way, everybody, I put my website into the chat. So if you want to reach out to me, you can go to my website. You can book a consultation on the website. There's a big button right at the top of my website. It says book appointment. You can book a free call. If you want to get to know more about me and my services, see if we're a good fit, you can book a free 15-minute call. So please feel free to reach out. When is the next presentation? Austin, I'll let you answer that one.
Well, the next presentation, we're right now preparing for some activities during National Small Business Week, which is from April 30th to May 4th. Is the first week in May. So I'm just trying to finalize some things with a couple of speakers. So if you have my information, I will get that information out to you. If you registered, I have your email address. I will include you on the email blast that I send out to everyone in my contact, and we'll get you that information. Because this year we're doing webinars like we did last year. So it's not every month, maybe like every other month, or you might skip 2 months and then do another one. And then so I'll let you know when National Small Business Week comes, we would like to have another webinar for our audience.
And if you missed half of the webinar, you can always reach out to me directly. You have my website, you can hire me, and you can get all these tax tips, with a paid consultation.
Right, definitely. And then it's being recorded, so everyone who registered will get a copy of the link to the recording, so you can actually look back at the conversation at your leisure. But Bill, I got a question.
Yes, sir.
I'll jump it off. Can you do a bonus depreciation on, let's say if you have a delivery service utilizing motorcycles, can you do a bonus depreciation with motorcycles as you do with automobiles and dump trucks?
Yes. If it's a vehicle that is used for a business, you can do bonus depreciation on that vehicle. Again, it has to be used 51% or more for business. Those are the IRS regulations. Now, that's one option. If you don't want to go through the bonus depreciation, you can always deduct the mileage. Business mileage is tax deductible. The mileage rate changes every year, but for 2023, I believe the rate is 65.5 cents a mile. So another option for getting that deduction without bonus depreciating the motorcycle or the vehicle is just track your mileage. You know, IRS regulations say that you have to have some kind of tracking software, but there's a number of different mileage tracking softwares on iPhone and Android apps. One of the ones I like is called Mile IQ, MILE, capital I, capital Q. You download that software and it comes with a built-in GPS. And whenever you drive somewhere, it's going to track your miles. Now, at the end of the day, you got to come home and you got to log into the app on your phone. And then if it's a business trip, you have to swipe right for business and swipe left for personal. I recommend my clients, utilize mileage tracking app, if they drive a lot for their business, no matter what business you have, unless you work at home. But if you're a real estate agent, you drive around a lot. If you have a delivery service, you drive a lot. You got to be tracking your miles. If you have employees, you have to check the odometer and, check the odometer January 1st and December 31st on that vehicle. And then that's the way you can, track your miles. Now, I know we're well past January 1st, but start now. Start from April to December. And then you're still going to get, 9 months worth of miles. Just track it on the odometer, and then you can write off the miles for business on your tax return. So you have a couple of options, tracking your miles or doing the bonus depreciation to get mileage deductions or deductions on vehicles.
But you can do it also for motorcycles, right?
That's correct. Whatever type of vehicle it is, it's still business miles. It is, whether it's a motorcycle, it has to be a motorized vehicle. So it has to be a motorcycle or car. I don't think you can write off depreciation or miles on a bike. You know what? I've never had anybody ask me about bike deliveries, so I'd have to research that. But I know you can do motorcycles in cars and trucks, and so I'm pretty confident with that.
That's gonna be my next question. Like if when you go to any downtown municipal area, you see bikes that you can rent and then ride around the city, whatever, because that's owned by a company.
Right, but you can't get a deduction for that because you don't own that mode of transportation. It has to be something that you own or you lease.
Gotcha.
So if you're leasing a car, you can get it. If you own a car, you can get it, or if you lease or own a motorcycle, but if it does not belong to you and you're not leasing it or owning it, then you cannot get the mileage deduction or the bonus depreciation.
Okay. And in terms of, and I just anybody else has questions?
Come on, guys. I know you got some questions out there.
They got questions, because when the call is over, they're gonna be like, man, I should have asked that.
Okay, well, maybe they have a good accountants. Well, if you have a good accountant, you probably wouldn't be on this, on this webinar. You'd probably be asking these questions to your own accountant. That's another thing. If you can't ask questions to your accountant, it might be time for a new accountant. Now,
that's right.
I want to say that if you call your accountant, you have a question, and between like March and April, they're going to be really busy and they might not be able to get back to you right away. But if you contacting them and it's July, August, they should be able to have some consultations with you, because that's, well after tax season. But if you're contacting them like this time of year, they might just be like, hey, I'll get back to you on April 19th, So just expect that, if they're good accountants, they're going to be really busy. And, unless it's really, really important, you might have to wait a little while. Right.
And I got two other questions if no one else is asking questions, but this is also for the audience as well to hear. Should certain businesses use specific software for like, let's say you have QuickBooks, you have Quickens that you just mentioned, but let's say, for instance, construction business versus a medical office versus someone who owns a daycare, etc. Or is it would one software apply to all those business models?
Well, the best software in my eyes is the software that you're going to use. It has to be something that you feel comfortable with and you're going to use it. So if even if it's free and you don't use it, it's not worth it. So the most important thing about software is using it. I know people who pay for QuickBooks and then they can't use it because it's so difficult. I mean, QuickBooks is designed for like an accountant. If you're not a professional accountant, don't use QuickBooks because it's going to frustrate you. I always tell my clients, find something that you like, find something you're comfortable with. And, if it's free, that's great. If you don't like software, use a spreadsheet. You can Google, spreadsheets and And you can find a spreadsheet that you can utilize for your business. So
Yeah.
there's, if you feel comfortable with spreadsheets, you don't like, doing online, you're afraid of getting hacked, that's fine, but use something. That's what I recommend my clients, use something. And if
Yeah.
you're not going to use software, delegate it and hire somebody to do your bookkeeping. Don't just let it sit and at the end of the year, try to go through 12 months worth of bank statements. So either you learn how to do it yourself, get comfortable with it, or delegate it, pay somebody, and get it, but make sure it's done.
Yeah. And they can go to the local SBDC Small Business Development Center and SCORE office, speak to a consultant, and maybe the consultant can recommend a specific spreadsheet that they can use to
Well,
organize your
they
expenses.
they can't go into the SCORE offices here in Atlanta. We're
Mhm.
doing everything virtually, so they can sign up to get a SCORE mentor, and
Okay.
they can do it online. But we're not going into an office. We haven't been in our office since 2020. Just like you, you went
Right.
virtual, so did we. So we're
Right.
SCORE is not doing anything in person. Everything is either Zoom or by phone. Um, but yes, they could theoretically go to SBDC or SCORE, and they're going to get the same recommendations that I just gave. When I give recommendations to my SCORE clients, I give them the same ones I just gave you guys. The
Right.
Wave, Divi, FreshBooks, Zero, and Quicken. Because they have free versions except for Quicken, but $50 is nothing. So
Right.
that's why I included it. Quicken has what they call Quicken for home-based businesses. So I just say try them all. Find find one that you like and then just use it. And if you're not going to use it, hire somebody. I think we got a question from somebody with the iPhone. I don't know the name. It says for bonus depreciation, do the items have to be purchased within the last year? No, you do not have to have bought an item in 2022 to do the bonus depreciation. You could have had an item from 2021, and if you're late, we can still do bonus depreciation as long as you use it in your business. We can do the bonus depreciation. Now, the benefit of items that were purchased in 2022 and before was that it was 100% bonus depreciation. Now, if you buy anything in 2023, or it's going to be only 80% bonus depreciation. But that's a good question.
Excellent. We got one more minute, and I want to reserve that minute for the audience. If anybody has a question, one last question. Don't be shy. Well, real quick, Bill.
Mhm.
For the solo 401k, can independent consultants and independent contractors benefit from that?
Yes, they can. As long as you have earned income, you can qualify for it. So whether you're getting paid on a 1099, or whether somebody's paying you through Cash App or PayPal or whatever, if you're an independent consultant and you have earned income, you can contribute to a retirement plan.
Right.
And
Now,
I strongly recommend it.
right. Now for receiving payment, real quick, should we avoid Cash App and Zelle and just do regular payments from like PayPal or something like that from a client? Or how does it,
No,
no?
I mean, they're all going to issue 1099s to you.
Okay.
So, starting in 2023, I'm sorry, Zelle doesn't issue 1099s,
Mhm.
but Cash App and PayPal will be issuing 1099s. Zelle, because it's like bank to bank, there won't be a
Mhm.
1099. So I know that some people are going to be using Zelle to try to avoid paying taxes. I don't recommend that, you
Yeah,
know,
no. Mhm.
but that I know that some business owners are change their business model to say, I'm not going to accept, PayPal or Cash App. I'm only going to accept Zelle,
Right.
to receive payments, or I'm only going to accept cash. Um, if you do that and you get caught, the IRS is going to, fine you and penalize you if you try to, circumvent, the reporting requirements. But, you can accept money any way that you want to.
Mhm.
Um, Now, if you accept it through Zelle, you don't have to pay the fees. Like PayPal has fees.
Right.
Um, so
Cash
I know
App.
Zelle doesn't have any fees, so you would avoid paying fees. But those fees are going to be tax deductions on your tax return.
Mhm.
So I always look at it like this: whatever makes it easier for your client to pay you,
Mhm.
and that's what you want to utilize. If the
Right.
client doesn't have Zelle, and what are you going to turn them away because they don't have Zelle? You're not going to
Mhm.
let them pay you. So I
Right.
would say have options.
Yeah.
Everybody doesn't have Zelle on their bank. So you don't want to lose business just because you only using one method to receive payments from your clients.
Right, right. Well, we're right at 7:32, and again, I like to respect everybody's time. I like to get started on time and end on time. I wanted to say thank you. We can just give a virtual applause to our speaker, Mr. Bill Hampton, who brings it with a wealth of knowledge on taxes and finances. Bill, I want to thank you so much for spending time with us this evening and just agreeing to be of value to this conversation. We know business owners, entrepreneurs, whether you're 1099, whether you're a solo operator, whether you run a micro enterprise, a small business, we know that we're all bogged down and consumed with various questions that we have pertaining to our taxes. And since this is tax season, we're well into it. And we know that some of you may not have filed your taxes as yet, but it's great to get these tax tips, and so this way you can go forward and be responsible for filing your taxes the way in which that you can avoid getting audited by the IRS. And as Bill provided information here tonight, he has his contact information in the chat. I hope you guys copied that down. Please reach out to Bill. Like I said, I've known him for like almost 10 years now. He has a wealth of knowledge and information that he will be more than happy to consult with you on. Definitely sign up for his consultation. On the next webinar, just stay tuned for information on that. I have your email addresses. I will be including that into my database, so this way you will get whatever I send out to my listserv. You all will get that as well. I know that we're excited. We're growing businesses. We're entrepreneurs. Just out here trying to do what we can to make sure that we're growing and scaling successfully and building successful businesses. So I applaud you on that. But let's do it right, and let's do it the way in which that we can be truly successful at our business. All right. I want to wish everybody happy Easter, Ramadan Mubarak to Muslim brothers and sisters out there. And feel free to reach out to me as well if you have any questions. All right. Again, thank you, Bill. Thank you so much, and I'll be talking to you, man. All right.
Thank you, Austin. I appreciate the invite. I appreciate this opportunity. Thank you, everyone who joined tonight. Jerry, Latoya, Oba, and Malika, and Wawan. Thank you for taking time out of your busy day to listen to me talk.
That's right. All right. Everybody have a good evening.
Okay, take care.
All right.